This one single indicator from Chart Prime Indicator Suite will completely change how you trade and your win-loss percentage. Welcome. Today I'm going to be showing you the most powerful indicator on the market when it comes to technical analysis. I've used a lot of tools and indicators within this space. The best that I have found comes from Chart Prime's Indicator Suite. Check this out. We're going to be taking a look at Avalanche today, AVAX. Right now it's on a 1 hour, but when I go to do this TA, I'm going to be showing this trick and this tool on a 12-hour candle. First off, I'm going to go ahead and hide these candlesticks. I can't see where they are. I will not be able to see the price action. We're going to jump over to a 12-hour here, and I'm going to show you just how powerful the Chart Prime Oscillator is. Taking a look at this, at what I'm looking at on the oscillator from Chart Prime is some key things. These downtrend arrows, these ribbon flips where the oscillator says it's getting ready to twist, these peak seekers, these overbought symbols, oversold symbols, uptrend arrows, and most importantly, our divergences that auto print on the Chart Prime Oscillator. If we take a look at this oscillator here, I can literally tell you where I would go with longs and shorts on this oscillator without seeing anything else on the charts to include price action. Check this out. What I would be looking at here is I see this downtrend arrow, I see the red momentum dot, and there's a ribbon twist right there in the ribbon. So let's go ahead and bring this in. Bringing up this oscillator here, you can see that I've got a downtrend arrow here, I've got a ribbon twist right here, and I've got this momentum dot. If we go ahead, and I'm going to drop an arrow here, right on where I would enter that trade at. Let's go ahead and make that red, and this is going to be a short for us. Let's go look for another one. I've got right here a peak seeker, and I've got a divergence that printed here. So let's go ahead, drop a short entry there too. Now, prior to us seeing any of these bearish divergences here, I probably would have put one right here on a short. Right here, we would have went with the long. Right here, we would have went with another long. This would have been a long for us. This would have been a short for us. This would have been a long for us. We would have placed a short here. This would have been a long. This would have been a short. And there you go. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trades that I would have entered strictly off of the confluence of the Chart Prime Oscillator. Let's take a look and see how these trades turned out. First, let's look and see where our entry and take profit points would have been based on other Chart Prime indicators. What I have turned on here right now is the Market Oracle with the dynamic reactor activated. That is this green and red line here. I also have predictive ranges from the Chart Prime Smart Money Concepts bundle. Seeing that we have a definitive support line on the blue delta of the predictive range, right at the same time after getting this downtrend arrow and the ribbon twist, which is why we entered there, let's go ahead and drop a short there. Taking a look at this trade, we would have set our stop loss just over our previous range here, and we would have entered on the candle close leading into this ribbon twist. We would have taken our target for this trade with 50% at the lower gold band of the predictive ranges here, and take profit 2 at the lower support. Upon this trade hitting take profit 1 here, we would have moved our stop loss to our entry line. And this is a good trade. Looking at our second trade that we placed here based on the oscillator's indicators, we would have entered this trade here. We would have taken our previous range for our stop loss just above this previous candle. This would have taken our take profit line down to the support range of the predictive ranges. While this trade did not make it all the way down to this line, remember, we move our stop loss to our entry. So we take 50% of our profits here. We did not catch the full 100%, but this is still a profitable trade. Now on this third trade here, we can see that we did call for a short. We had the overbought, we had the downtrend arrow, we had an evening star from the candlestick patterns, and we had a reversal down. This trade would have been stopped out. Let's take a look at our fourth trade. On our fourth trade, we went for a long. entering this trade here, setting our stop loss down below this purple line of the predictive ranges. We would have shot for this to have gone up to our lower gold band of the predictive range, giving this trade the full 100% range of its projection. On the next trade, we also called for a long. This trade would have been placed at this level. However, based on the fact that we have a support line here that we were underneath, I would not have probably entered this trade with all of my indicators on, knowing that we were against heavy resistance. I would have waited for this trade to close a candle above this support line, get a bounce on retest, and have entered there. However, based on the oscillator alone, this trade would have been a bad trade. Looking at our next trade line, we would have entered a long based on the oscillator, the peak seeker, and the bullish divergence. This trade would have been entered on the print of this peak seeker with the oversold and the bullish divergence on the oscillator. We would have set our stop loss just below the purple line. You can see that the stop loss would never have been hit on this trade, and we would have rode this all the way up at take profit 1, and most likely at that point took our take profit 2 at the delta. That being said, that means that we may have never even taken this trade because we had a better entry that played out on the long term. The next one we're looking at is where we called for this short. This short would have been taken due to the fact that the oscillator had given us previous downtrend arrow and overbought, and now we have printed a divergence on the oscillator. Let's throw a short on and see how this looks. We're going to move our stop loss above the previous wick area. We're going to shoot for a target of the support line of the predictive ranges, giving us a 2-to-1 ratio on this trade. On this trade, we would have entered due to the bullish divergence, the peak seeker, and the uptrend arrow, giving us all at the same time that we got our ribbon twist and that uptick. Let's take a look at how we would have entered this long. The long would have been entered at the candle close. We would have shot for a target of the delta here, moving our stop loss down to our support line of the predictive range, giving us a 3.3 to 1 risk to reward ratio. Again, this target did not hit its full extension of the take profit, but we would have taken 50% profit on the gold line and moved our stop loss back to entry. Once we broke this level here is where I would have looked at closing out this trade, as opposed to letting it come back down to our new set stop loss at the entry point. Looking at our next short here, we would have entered this trade based on the downtrend arrow that had previously printed, that we had momentum dot in the ribbon twist, and also for confluence, we had rejection of the dynamic reactor and the blue delta line of our predictive ranges. We would have entered our short on the delta line, placing our stop loss above the previous cluster of price action, with a take profit line down to the lower support line of the predictive ranges here. This trade would have given us a 3.8 to 1 risk to reward ratio. This trade ultimately would have completed to fruition at a later time. However, if you would have taken take profit 1 at this point, and then upon it coming back to this point, you could have gotten all of your 100% profit on 2 take profit portions at the same level, ultimately giving this trade a level of 2 to 1. Let's take a look at our next trade. This trade here, you can see that we have the bullish divergence, we have the oversold, the uptick arrow, and we have the ribbon twist. At the same time on this trade, we also have the possible reversal up, and we had a test of our lower golden trade band of the predictive ranges. We would have entered this trade on the lower trade band of the predictive ranges, setting our stop loss just below our previous price cluster. Now, typically, I would have shot for this trade to go to its upper trade band because price tends to trade between the 2 gold bands on predictive ranges. However, due to the presence of the dynamic reactor falling in line with the blue delta of the predictive ranges, I probably would have taken total profit there on this trade, meaning that this trade would have been a 2.5 to 1 risk to reward ratio. You have to remember, just because one of the indicators told you that it was going to be a trade and you have your normal bands, you have to look for confluence of other indicators within the Chart Prime suite and traditional TA to know when it's time to get out of your trade. This double resistance of the dynamic reactor with the blue delta is a fantastic spot to know that you've got double resistance, and it's probably time to close this trade, take your profits off the table. The final trade we're looking at is this initial short that we would have done here. Now, taking a look at this trade here, you can see that we did have the overbought, we had the downtrend arrow, we had the ribbon twist, and that is what told me on the oscillator that this would have been a good price. Remember, there was nothing on the upper chart when we decided to make these calls. We would enter this trade at the point of it printing the ribbon twist and the momentum dot. We would set our stop loss on this trade above the previous candle. Our target on this goal would be to the delta. This would have given us a 1.5 to 1 risk to reward ratio. If you wanted to, you could even move this stop loss down to the upper resistance line of this of the price action. Due to the 1.5 risk to reward ratio, I would not feel that this is a good trade to get into because I prefer a higher risk to reward. I personally would have probably waited for a retest of the upper resistance line of the predictive ranges, setting my stop loss just behind the previous wick. That would have given us a 5.8 risk to reward ratio. And that is what you need to look at when you're doing some of these trades is the reward that I'm going to get from this entry worth me taking this trade? Anything under a 2.5 to 1 risk to reward, I would never take. By waiting for a retest on this trade, we have maximized the earning potential of this trade and given us a 5.8 to 1 risk to reward with a target percentage of 26.97% gains without any leverage. Now let's go back and take a look at how all these trades turned out. Again, we took 11 trades on this test run of the oscillator. Of these 11 trades, only 2 of these trades turned out to be invalidated, getting us ultimately to a stopped out point. But that's why we set stop losses. So there you go, guys. This one single indicator is super powerful on finding when to get into a trade, when to take a short, when to take a long, offering you multiple indicator confluence on one single indicator system. This is the most powerful oscillator in the market, but it should absolutely be in your arsenal of tools when you trade daily. My daily trade success increased massively when I added these indicators to my chart. If you too want to harness the power of Chart Prime, and if you'd like to add these indicators to your charts too, check out the link below for 45% off Chart Prime today. You're going to get the most powerful indicator tools on the market. You're going to get education. You're going to get webinars on how to use them and the best trade community around anywhere. So what are you waiting for? Don't hesitate. Click that link, get these indicators on your charts today, and get primed.